Welcome back to NinjaTrader Live. Be your co-host Tom Schneider, CMT with NinjaTrader. My pleasure, as always, to be speaking with the other host of this show, Anthony Crudele. How you doing, Anthony?
I'm doing great. I got the camo on
I
for
love
the
it.
day after the hurricane. And so, yeah, I was excited to see that I had power this morning, lost it last night. I'm sure we'll talk about the hurricane a little bit, but we're really good here in Naples, and I feel bad for a lot of the people that really got hit, north of us, and we dodged this one a little bit.
Yeah, we were glad to hear. I was glad to see your email this morning, saying that we were on, but of course, that's not the case for everybody. 3 million people lost power, Anthony.
Yeah, I mean, I didn't even lose power in Ian, and Ian was actually a lot worse for us here in Naples.
Yeah,
Last night conditions were almost, um, I would say, muted compared to what that we've seen compared to Irma and Ian. Wind picked up late last night. Not a lot of rain here in Naples. Wind just really picked up heavily, probably 60, 70, maybe
oof.
even a little bit more miles per hour. Went from like nothing to all of a sudden the trees were sideways, and then we lost power late last night. I was up, might have been having a few glasses of wine, waiting to see what was going to shake out, and that was it. Power went out this morning. Woke up, checked everything out outside, no damage. See some debris, and the problem was just the power, and that came back on, and I'm with you guys now.
Well, thank goodness. I'll tell you, it's Superstorm Sandy. The night that my wife, she always runs a practice turkey for Thanksgiving. And the night she chose to do it was the night the storm hit. And she still made the turkey. We were no power, but the oven was working. So, I don't know. It's just things you remember about these really impactful storms you'll never forget. But thank goodness you're all right, and your house is okay and all that.
Yeah, I mean, we right now we have minimal water. As Mike was saying, he'd rather have water than power. And like for us, because I have so much water, I bought
Right.
so much, and we kind of keep it that thankfully that isn't an issue for us right now. But we're on water conservation, and you can't really drink it yet because
Wow.
once again, the surge has been the big thing these days with these hurricanes. The surge, I think downtown Naples got several feet. It's like I think it was 5 feet or so, which is not far from me. But I'm just far enough inland to where it doesn't impact us, but it impacts the water situation. And so, and it is what it is, man. We always move forward. I mean, we're getting, unfortunately, too used to this down here in
Yeah.
Florida.
Yeah, yeah, too many once in a lifetimes or once in every 20 years storms, but
Yeah. Right.
you hope people obey the evacuation orders, right?
Oh
That's all
yeah.
you do.
Exactly. And so for my fellow traders that are out there, first of all, thank you guys all for reaching out to me. I got so many messages. It was crazy. And I'm glad to be here today. And let's talk about some markets. We're going to talk about micros versus minis, but I'm going to do some market environment first because it all stems from that, Tom, right? At the
Sure.
end of the day, when you look at a micro versus a mini, I mean, we all know that the mini is going to be 1/10 the size. Everybody knows it at this point. I mean, micros have become an even more popular product than the minis. And I think that it's a mistake in some ways because obviously there's a place for the micros, there's a place for the minis, and for me it comes down to style and market environment. When you're looking at a micro, my mindset is always, if you're a new trader, a micro is obviously the path for you
Sure.
because it's a smaller product, right? But if you've been trading for a while and you want to try out a new market, some of you maybe are trading S&P or Dow or NASDAQ or Russell, and you want to go into one of the other markets, or you want to go into crude. Crude micros become a massively popular product, right? I mean,
Right.
I've seen so many crude traders move into micros, and I think it's good for strategy testing, but once you test it, you have to check the box. Is it, what style are you trading? Are you trading in a swing position? Are your stops really wide? Because you're going to pay a lot more for a micro, and you're going to get a better bang for your buck in trading the bigger contract, meaning that
Mhm.
you're probably going to trade more contracts. And if you're working your way up to a full CL or a full ES or a full NQ, you want to make sure that you're actually being with the bigger product, so you don't trade too much and really over trade yourselves out of situations and cost yourself too much in fees. I mean, that's a mistake I see a lot of people make. They think just because it's a small tick value, what happens is that they commission themselves or fee themselves into a hole. And
Right.
so that's why today, what I want to talk about is let's go into market environment first, understand it, and then I'm going to go over some scenarios where I think that the micros just make sense. It doesn't matter how much money you have or don't have. Sometimes a micro or a mini is a better trade.
Right. And yeah, let's take a look at the charts. I think just to be clear, those who are new, the minis are bigger than the micros. It's easy to get mixed up, right? Because
That's
micro
so
mini,
weird.
if you're talking about a food or some, clothes or whatever, what's the difference? But in futures, it does make a difference. The micro is smaller than the mini. So let's just make sure that's in our brains.
Yeah. So let's start off with crude because obviously during hurricane time and during geopolitical times, I mean, the crude oil market has been on my radar for a while. Obviously, because of you have geopolitical tensions. Anytime you see missiles fired off, I mean, this is like basically 101 into futures, right? You don't need to be an advanced trader to know that. Oh yeah, there's geopolitical tensions out there that you want to watch the crude oil market. I mean, that's something that everybody under the sun understands, and so we are the center of the universe with the CL product, at CME Group for WTI, West Texas Intermediate Crude. And so that to me is a product you want to look at, whether you're trading it or not, and you want to understand market environment. Also for inflation, we got CPI this morning, CPI. You want to watch what crude oil is doing because it has an impact, has a ripple effect across really everything that we do here as consumers in the U.S. So you look at the crude oil market. Let's talk about it from a technical perspective. Tom,
Mhm.
as you know, I'm going to have my 20-period 3 standard deviation Bollinger Bands. I'm also going to have some moving averages up here. And I go back to this, like the moving averages, the more you are a day trader, the shorter time frame you want to have them on. When I'm looking at market environment, I'll use anything between a 5 and a 10 to understand what the trend is. And the reason
Mhm.
why I'm between a 5 and a 10 is because that's my time frame. I'm not overly concerned about what a market's doing on a 21-day or a 50-day or a 34-day. And I do keep them up to kind of give myself visually an understanding of what the bigger overall trend is, how how long the trend has been intact. But ultimately, I'll keep a 5 or a 10 or an 8 period right, here just to kind of see what's going on. And then that's all we need. And that and my Fibonacci retracement tool. And when I look at market environment from crude oil, we go back to here. You could really kind of time this even back to what's been happening with Israel and Iran. And it's been, even though it's not been a super clean trade, there's been this underlying bid in crude oil. And so when we look at it, one of the things that I look at in market environment and why I'm starting in crude oil is just because, like I said, it's a hot topic, obviously,
Mhm.
I think for so many reasons, is look at what I always look to see what it's doing relative to my 50%. So my Fibonacci retracement is from the top Bollinger Band peak to the bottom Bollinger Band peak. Whichever Bollinger Band peak encompasses the Bollinger Bands post where you draw it, right? So like if this Bollinger Band were to get above the high or below the low, then these would become invalid to me, right? And
Right.
so once it encompasses an area, that basically tells me we're boxed in. Like the market it's gone from expansion to now contraction, and now we're just in this area where I use a 70%, 50%, and 30% level to understand how the market's reacting to a time of contraction. And the reason why I think about it from that perspective is because when we're between the 70 and the 30, it really tells me that we're caught in between the meat of what that volatility expansion was, right, Tom? So like that meat, like that peak high and low where the 3 standard deviation went out and then it came back in, and then it's like,
Mhm.
okay, now we're coming in for contraction, and it's like, okay, is the meat of the trade taking place in here? If it gets below or above that 70% area, then I start to look at it and say, all right, we're now potentially into expansion again. And why I talk about crude first today is 75.23 is key. I mean, you can see these moves are pretty wild right now in crude oil. There's just a lot of crosswinds in it, and I think that underlying though, it's holding the 50%, which is really that gauge of like, can expansion go higher or expansion go lower? And if we start holding above 75 and a quarter, I would not be surprised to see crude go into the low 80s. And so that's something we all have to watch, I think, as traders, because if crude oil starts really ripping higher, how does that start to impact really what's happening and indexes, everything, because crude oil is that commodity that everybody has to keep an eye on. So my initial thoughts when I'm looking at the markets right now are, if crude oil starts holding above the 75-ish area, we have it's kind of game on for a rally, and I think that it would be hard for me to see a reason not for it to go up into the low 80s.
Oh yeah, we've been pointing out 75 just as a psychological number as well, but you look left, you see a lot of trading, in late August, kind of mid August, and even in July, we keep coming back to 75. Now we're coming back to it from the lower end, and your moving averages, your 5 period moving average is going to stay close to price, but we really haven't closed below it since about end of September. So that is very bullish, and I like the idea of breaking up your expansion, your Bollinger Band zone into expansionary and kind of I won't say contractionary, but kind of sideways motion as we break out of 70%, happens to be right at 75. So I don't think there's a coincidence there.
No, and when I see this like this, so I go back to like your moving averages,
Yeah.
or a ripper down into the low 70s. This is a market where this is where I go back to micros versus minis. This is a
Yep.
market where most traders are probably going to be trading micros in this if you're trying to participate long, because the volatility is really high around this area. We're trying to break out of a downtrend that it's been in for quite some time, and the market is just not going to make it super clean. And so what I like in a micro versus mini scenario, which is really it's not a mini, it's a crude oil versus a micro, because it's not mini crude oil, because there actually is a mini too, which is a whole nother topic. It's kind of
Right.
like there's the in-between product for crude, the QM. But I look at micros versus the big, the CL. And
Mhm.
what I like is, I go back to it. Let's start off. Market environment is the key for every strategy. What environment are we in? Crude oil to me is got support from the macro, it's got support from the technical. It's trying to break out higher, but it's going to be volatile. My thought process is, I want to go to a micro and I want to try and buy dips using micros, because I have a wider stop for a longer term swing position. Even if it's intraday, I can widen my stop so I can try and stay in that position, right? Because there's so much news that can move this market. And so that's why you would choose a micro over a mini in this specific situation, or mini. I go back to a big one. So it starts with market environment and then how you're going to go about trading it. And so this is a very simple one that, like I said, with crude oil. And now let's go into the indexes, and I want to talk about what we're seeing in S&P, Dow, and NASDAQ. So here's the ones where we have majority of the traders really participating in. You've got so many micro traders that have come to the marketplace. I'm a mini trader in the S&P. I actually use micros and NASDAQ, here or there, but I
Right.
pretty much use minis for everything across the board. And it goes back to the main theme: when to use a micro versus a mini.
Mhm.
Micros are strategy testing. I think if you're in any mini S&P, or if you're trading the NASDAQ, Dow, or Russell, and you're looking to go into a different market, I believe in testing your strategy if you have the financial ability to put it in a live market. A micro is a much better place to trade, to test a strategy, because you're actually getting real fills. I
Right.
think that so many traders are going into sim, and the expectations are totally skewed there, because you don't have the actual live liquidity. So you don't know how your fills are going to be in, you don't know how your fills are going to be going out. And so there's just a huge discrepancy when you go from automation of testing a strategy. And I'm not saying you're going to be automated, but you're testing a strategy through sim, and then you're moving it to live. The results never work out really the way you want. And micros can be a great place to test a strategy. You also want to look at micros anytime you're counter trend trading. So like anytime that I see a trend that like I want to go against, this is where I use the micro NASDAQs. If I'm going to short the NASDAQ, which I try not to do much often these days,
Right.
but if
Right.
I am, it's really, I'm going to use micros, because I'm going to use a wider stop, and I'm just going to break that order down into much a wider, area of execution. I'm not going to be super price sensitive. I'm not going to let the NASDAQ do a 50 handle ripper and just take me out of a big NASDAQ and then all of a sudden break 200 points.
Right.
Nothing pisses me off more, right? So
Right.
counter trend, I'm going to use micros. Wide stop swing positions, similar to what we started off with crude. If I want to be directional and I just want to hold it, like I actually used micro Russell a while back where I just kept buying, buy two or three, buy two or three. And I was trying to be long it, accumulating a big position, and I
Yeah.
would be buying them over the course of days or weeks. That's another good time to use it. Or if you want to use precise hedging, if you're long, a bunch of stocks right now and you wanted to short NASDAQ or S&P against that primary trend, a micro allows you to for precise hedging. You can hedge using a very small amount. You almost are using it in some ways like an option, but you're just doing it in a way where you're using a future and using a smaller product. And
Right.
so that's really the way that I lay it out. And then the minis, depending on the market environment for day traders, this is where I think the mistake is made, Tom. I think that too many traders, they come off of either sim or micros. They start there and they just they stay in the micro side of things.
Yeah.
And what happens is that I go back to it. They're over trading the trade. The micros biggest, I wouldn't say it's not a negative, but the biggest thing that holds traders back on from that stay in micros is they overtrade,
Yeah.
period. They want to be long. They are trading in and out of that position in that direction, and they are overthinking it, over trading it, over executing it. And that's a problem. And it's not even necessarily the fee aspect of it. What it is, the aspect of is that you never let the trade really work. And because you have more contracts on, you're a busybody entering in and exiting out. Where I think the minis really are important. If you're a short-term day trader and you have a dollar amount of risk, you can put in, your contract in an E-mini, NASDAQ, S&P, Dow, or Russell. As long as it's a dollar amount of risk, it might be a smaller contract size, but ultimately you're going to be less of a busybody in managing that position. You don't become a micromanager, which I think is where so many people make the mistake. And when a market starts to run because you have that position on, then you'll, I think, a lot of times start to train yourself to hold that position longer. And so those are like mentally what I think about. If I want to be in a mini, I want to be in, and I have a tight stop intraday or a tight stop on a swing position, I'm always going to choose mini when I'm going with trend, because I want to have a bigger position, a better bang for my buck, and I want to be in an area with a larger position as soon as possible because my stop is relatively tight and I'm going with trend.
So, Anthony, to that point about being an over trader using the micros, when you're coming off sim and you're using micros and you're trying your strategy and you're getting your feet wet, at what point do you say, okay, you know what, I can graduate to the E-mini, but if you're over trading, you might not see the results. You might be hesitant to go into a bigger time frame. Like, how do you overcome that?
Well, first of all, when you start off in a micro, the micro is what buys you time and it buys you experience. I would say that there's no specific time period that I know
Sure.
that the person transitions, right? But let's talk about a scenario. Let's look at market environment here.
Okay.
And let me go into a mindset, I think, where you would always choose a mini over a micro if you financially can afford it. And also, obviously if your account size is big enough, and then if you have enough experience to do it. So here we are with the Bollinger Bands, 20 period, 3 standard deviation. I talk about this. Here's the moving averages. S&P, I talked about this the other day on my free note, roughly 58.10, 58.13 until we started to see a daily close above it. I thought we were going to come down and trade 56.88. We didn't quite get there. And ultimately the market just had, just stalled in its tracks. I mean, once again, the markets are not rotating to the downside with really any clean moves. But I knew in this area, this would be a rotational area. So during this period of time, let's think about it. Let's go back. If I'm a short-term day trader and I want to be short, I'm going against primary trend,
Right.
number one, right? So if I'm going against primary trend, intraday micro. Why? Because I'm not going to get blasted on being short S&P. I don't want it to happen,
Yeah.
right? I'm counter trend trading, okay? And I'm probably going to try to be a little bit of a wider stop, because if I'm trying to be short, I'm going to use a smaller position with a wider stop because the market overall trend is still up. So,
Yeah.
and this also goes back to precise hedging. If I'm long a bunch of stocks and I'm coming into the futures market and I look at it and go, I want to be a little bit short here, look at Delhi says we might slow down, or I see this on my chart, you sell a few micros against your overall position. That's a time to where you can be short small and not get blasted. Now you get back above 58.10-ish area. Now, to me, the market looks like it could be an expansion. What I do is I then go to my short-term day trading, and let's take this down to here. And now, because I believe the market is going to be bullish, now what I look for is I wait for my A setups to go with primary trend, and I'm going to use a mini because my stop should be tight. Think about this, everybody. Once you have a bias of a daily from the daily chart or whatever your wider time frame is, once you get down to a shorter time frame, your stop can be tighter, right? I don't have really wide stops when I'm trying to go with primary trend. I'll typically try to get in as soon as I can with relatively a tighter stop, because if the trade is right, it's unlikely the market comes back down too far to, number one, get me into where I want to be in, right? So I'm going to be less price sensitive going with primary trend. I want to step in right away because I want to try and go with it. And my stop should be tighter, because if it's going to work, the trade should start to work right away. Because anytime short term is aligned with bigger picture, I would always want to choose the E-mini or over a micro. And it's because I want to be able to maximize my position sizing for that market's direction, right? And so that to me is 101. You want to wait for that pullback in primary trend. Like if I'm bullish and I'm looking for an area to buy, I want to buy that with a mini. Why do I want to buy that with a micro?
Right.
So I have a small position on when it finally goes my way. Now, mind you, it still could be wrong, but you could say that about any trade. But ultimately, I want to maximize my position sizing when primary trend is aligned with short-term strategy.
And Carlos is one of our viewers. He throws this in, and if you're wrong, right, you have a tight stop because you're thinking, if I'm bullish and the overall trend is bullish, we're probably going to be bullish, and a tight stop is okay because you can always get back in again after you get stopped out.
Exactly. And and for me, anytime that like today is an example of, so this, let's talk about what this is real quick, because there's no real trade setup for me today, but let's just look at this from this perspective here. When you see, I use a 3-minute chart, and I'll look to see where the anchored VWAP is from the RTH, regular trading hours, right? And then I'll look to see if it can get outside this zone. This is just a 3-minute opening range bar. So I highlight the zone as like this yellow is neutral. It's really a no trade for me. If the VWAP can get above there, or below there, it would tell me what type of day potentially it is.
Right.
And so this morning it got a smidge below it, but then on the rally it came right back up in it. I mean, it's just, the market is ultimately just, it's in a consolidation mode today. But if I all of a sudden saw a scenario where, there isn't one that's clear on this chart, but if I got a buy signal, and anybody, it doesn't matter what strategy you're using. It's not about me teaching you an exact strategy here, but it's about understanding that if I saw a signal today to be long, I would use the tightest stop possible, and I would maximize my position sizing within a mini, because I'm going with primary trend, and I finally got the trigger on the short term. And it goes back to why it was Carlos, you said, right?
Yes.
I mean, he's exactly right. I mean, I always give myself, I use the rule of 3 for so many things. I've been using that for over 20 years. I typically get in a third, and a third, and I typically will give myself 3 strikes, you're out. It's a very baseball reference, and I think a lot of people can relate to it. It's nothing that, it's millions of traders do this. And, they all have their own kind of, quirky way about doing it, right? And so for me, if I'm wrong the first time, if it's with primary trend, I give myself 2, maybe 3 times to be able to do it, right? And then it's like, okay, done, right? If I'm going against primary trend, for example, the other day I got clipped on an 8-point move. I shouldn't even have been trading that day, but I was trying to be short S&P, and I actually got kind of clipped out at the high tick almost, and I was short, and I lost 8 points in the market. Now, on that specific day, I stopped right after that. Obviously, I was coming into a hurricane, so that was part of it. I was kind of like, what am I doing here? But that's a whole nother segment.
It's a mindset.
But I'm like, buddy, you just lost 8 points. And I mean, I knew, and I really wanted to be short, but I'm like, listen, you're going against primary trend. You're either going to sit here and get killed all day long trying to be short, or you take the lump and move on. And it was one of those things where I just took it and moved on. But I'm not going to fight a counter trend trade with minis and try and stay against primary trend and giving myself chances.
Right.
I mean, it always comes down to, at the end of the day, everybody, micros versus minis, it comes down to market environment and position sizing.
Yep.
If everything is lined up and you're with primary trend, you want to maximize your position sizing. The market is about taking advantage of moments. If you're always the same size in every position, it's very difficult, in my opinion, to ever fully take advantage of the market, because the market is most likely to take advantage of you when you're going against primary trend, right? Or if you're going against multiple confirmations. So why go win with full minis? That's where you use micros. You test strategy. You see what the market's doing in those moments to learn from it. You don't go in full positions. Full positions are always going to be when everything checks the boxes. And yeah, you're going to lose on some, but the ones that if you've done your homework right and you believe in your strategy and it works, those are the ones you're going to capitalize on more in those moments. And that buys you time in this industry because you make more money in that moment. And most people are just churning. They're not getting ahead. They're just getting a little ahead, and they're getting a little behind or whatever. And they're never maximizing it. And so to me, that's one of the key separations between when using a micro versus a mini.
Well, and to that point, when you're contra trend, you're thinking, I'm not going to hit a home run. Maybe I'll get a single or a double, to continue the baseball reference. When you're trading with trend, you're hoping for that home run that comes along once in a while, and trade accordingly, right? With your position size.
Look how many banger longs there have been this year. I mean, I've caught a few of them with options. I've caught a few of them with futures, and it's like I've had a million mistakes in between them. And it's like the few winners that you have, they really carry you along as long as you were positioned right in the primary trend. I mean, once again, it's not always going to be the case, but looking at a bull market or a bear market, typically more times than not, right now, the bull strategy is going to work over the bear. So why would I want to leverage the bear strategy? Just because I think the high is in, you're going to get crushed.
Right.
So
we have a little bit more business, the BFF.
Yeah, the BFF, Bitcoin Friday Futures. It's just getting launched. It's a CME Group weekly Bitcoin futures product. It's 1/50th the size of Bitcoin. We're seeing more and more crypto people come in to the futures markets, which I think is great. It's the only way that I trade Bitcoin nowadays is through futures. I used to own spot all the time. I've gotten away from it. And I use futures just to trade the price action in it. And this is a new product that expires every Friday. It's called, Bitcoin Friday. And so it starts on a Monday, it closes on a Friday, and it's 1/50th the size. So it's even smaller than the micro. This is 1/50th, the micro's 1/10. And this is another product that could be used as hedging or trading or what have you. But it's a small amount of Bitcoin that I think, as it says here, has a lot of potential. And I'll be curious to see how day traders react to this product, because this does fit more within that really small trader that wants some exposure to crypto. And I think it's a really good product that CME Group announced.
Yeah, it had a good launch. We had Craig Buick on from the CME talking about it briefly on Monday, and great launch. And so we'll probably be showcasing that more as we go along.
Yeah. I mean,
awesome.
Once again, CME keeps putting out products that, for the retail trader, if they want to participate, they can, and it just gives them different options.
Love it. Anthony, thanks so much for coming on, and great to hear that you are doing well in light of the storm.
Thank you, everybody.
The following presentation is for educational purposes only. All the symbols, trading ideas, and market commentary are for educational and demonstrational purposes only and are not recommendations or trading advice. Live sample trading occurs in a simulated environment. Past performance may not be indicative of future results. All the information and content presented is provided by NinjaTrader LLC, and the opinions expressed by all third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involves substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.